Hello, welcome to revision tips for CIPS Level 3, Advanced Certificate in Procurement and Supply Operations. This is Module 3, Contract Administration, Learning Outcome 4, which is to understand how to measure contract performance. We're going to look at the use of data, explain the use of KPIs, and the types of contractual risks and how to manage them. So firstly, let's review some key terms so we understand the differences. Data. Data is a set of facts or figures. It exists in a raw state without any context or interpretation. And that data can be qualitative or quantitative. The quantitative data is objective. It measures in things like numbers, and they can be absolute, such as the number of complaints we receive, or it's expressed as a percentage. For example, the percentage of time a website is not accessible. The qualitative data measures things that are subjective. And these are things like customer satisfaction, speed of response to complaints, proactivity, and innovation. But as I said, this data is purely just a set of facts and figures. It doesn't mean anything unless you interpret it. So when using data for performance management, it is important to try to be as objective as possible. So there is a need for qualitative data to be converted into numbers. It's normally done by creating a scale, usually 1 to 10 or 1 to 5. So if we move on to information, information is the data from the previous one that has been put into some immediate context, analysed and interpreted. So it's only data when it's just those raw facts and figures. It's information when you interpret it or analyse it. And then it becomes knowledge or intelligence when you have an understanding of the information in a wider context. And you're able to then use that to change outcomes. Before gathering data, you're going to need to do some planning. You have to ask yourself, what do you want to find out? What do you need to measure? What data do you need to establish that? Who can provide the data? How easy is it to assess? And how frequently you need it? So can you suggest where, who and how a procurement specialist might get the data for performance management? The answer is the supplier, the procurement team, immediate or end users, and general market analysis. So essentially it can come from any person or any group of people. The next step is to data cleanse. This is to check for errors, duplications and omissions. And computers can help us with this because it will look for things like typographic errors in names or product codes. For example, if something always starts with letters and then isn't starting with letters, so it starts with numbers, it can quite easily show you that an error has been made. But the key questions you need to ask when you're interrogating the data is, what does this tell us about performance? How does that match the contractual level of performance? Can it be improved further? If not, why not? And what can we do about it? You then manipulate the data to look for averages, trends, and compare the contract results with general market activity or benchmarking prices from other contracts by adding in the additional data. But the time you spend analysing data needs to be proportionate to the size of the contract. It might not be worth spending time for this on a £25,000 contract, but significant savings could be made from a multi-million-pound project. The actions here are showing you what's needed you can use to address underperformance, but it will depend on a number of things. So let's start with, what category is the underperformance? Is it delivery times, damaged or faulty goods, or incomplete orders? What's the nature of the underperformance? Is it continuous, sporadic, or habitual? The degree of underperformance, are they missing the target by 1% or 40%? That's quite different. Then ask yourself, what is this impact having on us? What's the underperformance having as an impact on us? If deliveries are like a few minutes late, probably not a problem. But if they're an hour later than requested, it could potentially have an impact on the performance of you being able to serve your customer. Equally, if it's incomplete or faulty orders, it could stop your production. And the final one is, what is the possible cause? And are there any mitigating factors? So, for example, delivery times are likely to be impacted by unexpected and severe weather. So maybe those ones can be exempted. So let's just give you some examples to think about. A supplier usually delivers on time, but delivery is 30 minutes late in 1 in 10 times. A supplier has failed to complete a building job on time due to an inability to reach site for 3 weeks as a result of flash floods blocking roads to the area. What about around 5% of goods are damaged or faulty in every delivery from a particular supplier? You can see by those 3 examples that the answers to those questions will be different in every single circumstance. So it's really important you ask those questions before you try and address the underperformance. The 5 whys and the Ishikawa Fishbone approach can be used to get to the root cause of the issues, because there could be multiple issues. So the example that's offered to us by CIPS to illustrate how the 5 whys works is by asking the question why 5 times. So it's simple, it really is. You're asking why the problem exists to get the answer, but you really do need to dig a little bit further. So the first, the one we're looking at actually is an example where a robot stopped working. So the first why would be, why did the robot stop working? And the answer was that the circuit had overloaded and it caused the fuse to blow. If you only stopped at that first why, you would probably change the fuse and be done with it. But it will happen again. So you ask the next question, well, why did the circuit overload? Because there was insufficient lubrications on the bearings. So again, if you stop at the second one, you're probably going to put more lubrication on the bearings and hope that it doesn't happen again, but it will. So why was there insufficient lubrication? The reason is that the oil pump wasn't sufficiently circulating oil. Why is this pump not sufficiently circulating the oil? Because the pump was clogged with metal shavings. And the 5th why was, why did the intake clog with metal shavings? Because there's no pump on the filter. So we're not changing the fuse, we're not adding more lubrication. We just need to change the filter on the pump, and we've got to the root cause of the problem. Now you can use this in conjunction with the Ishikawa's fishbone, because what this is showing you is that, the root cause is isolated to a particular category. So you can see the green categories on the fishbone diagram, and they could be people, processes, equipment, the environment, materials, or the measurements. And you isolate the issue to a particular spine of that fishbone. Is it the people because people are sick or demotivated? Is it the equipment? Has it broken down? This will help you to get to the root cause much quicker. The options you can use to address supplier underperformance is firstly to try and issue a deficiency, improvement, or a remedial action notice to tell the supplier that you're not happy with their performance. You can invoke a penalty clause, such as a service credit regime, which is where you can deduct an agreed amount from the invoice rather than penalties being payable. A liquidated damage clause, which is used when contract completion date is critical and the delay will have substantial financial costs for the purchaser. And these are common in the construction industry. Or you can use incentive schemes or gain shares. These come at the purchaser's cost, so the target must be valuable. You can terminate the contract if it's a performance that you just can't tolerate. And of course, you can find an alternative supplier. But where there's a genuine dispute, the next step depends on what the contract states without dispute resolution. So you might be able to escalate within each party's own organisation or go to an alternative dispute resolution method such as mediation, arbitration, or adjudication. Full legal proceedings is the final step, but you really should have the discussions to address underperformance first. I just want to go through the differences between a penalty and an incentive clause. So a penalty clause is one that seeks to punish a party in breach of contract, rather than seeking to ensure that the innocent party is compensated for their losses. And it's generally being held that penalty clauses are not legally enforceable. However, it has been challenged recently in a few cases. So an alternative to a penalty clause would be the liquidated damage clause I mentioned on the previous slide. As I said, this seeks to ensure that the innocent party has been given compensation by calculating a genuine pre-estimate of loss. And service credits are a deduction from the bill due to loss of service. There are tax implications to these, so you do need to be careful. So the opposite to a penalty clause is an incentive clause. In this case, the purchaser offers to pay the supplier a bonus for exceeding or agreed KPIs by a defined amount. Now, some argue that incentivizing achievement is far more productive than disincentivizing underachievement. The alternative is to offer gain share to add and share the additional value. We're now going to look at different KPIs for cost management and quality performance. So cost management, if you look at the one on the left-hand side, managing expenditure to reduce cost to a minimum level possible without causing a reduction in quality. It's not about staying within budget. It includes planning how much resources is needed to deliver a project, estimating what the project production process will cost in financial terms, budgeting or allocating finance to cover those estimated costs. The quality performance covers everything else that's not related to costs, such as delivery times, conformance to specifications, deliveries matching orders, compliance with policies and codes of conduct, the accuracy of invoicing, the responses to queries, compliance with relevant legislation, and risk management. And as we know, a KPI target is a fundamental part of your specification. It can be a non-negotiable minimum standard or a variable standard that has consequences for achieving it or not, as the case may be. But in all cases, the target must be SMART. Specific, measurable, achievable, realistic, and time-bound. Or relevant, and time-bound. In order to make KPIs useful in driving performance, they need to be aligned to your targets. And a target is a level of performance the purchaser expects the supplier to achieve. It's better to focus on key KPIs that have an impact rather than lots of things that could be measured. For example, you may know that 80% of orders are delivered on time and 90% of them are accurate. However, do you know whether that's good, bad, or indifferent? Because you've got nothing to compare it to. So KPIs need to be agreed by stakeholders from both the buyer and the supplier. And just a reminder that KPIs need to be SMART. So specific is explain exactly what you want to be done or what you want to achieve. Measure it in a way that you can check that it's been done. Make sure it's attainable or achievable. They need to be challenging, but you need to make sure they can happen. Relevant, they tie into a goal for your organisation, and time-bound allows for that to have a deadline to be completed. Now, audits can be used to verify performance and costs. An audit is an official inspection of an organisation's records and transactions. It includes some of the following: a detailed analysis of financial records, interviews with personnel, both senior and operational, questionnaires, a review of your contract documents and policies, and a process review of compliance with contracts or policies. Financial audits start with an audit of the purchaser's own transaction records, and it looks for potential areas of concern such as cost overruns, lack of detail on invoices, advance payments, and where a supplier might be claiming for extra costs. A process audit, on the other hand, seeks the causes of underperformance and non-compliance to the specification, and it's a visual inspection of the work and a process to identify discrepancies in the quality of inputs, a lack of quality control, or poor working environments. And audits can be carried out by a third party to alleviate any contention. When reviewing performance against the KPIs, the targets need to be reviewed at least annually. And the question you should ask during your reviews is, are the targets still relevant? If they're regularly met, could resources be better deployed to look at other aspects? Have internal or end users' aspirations shifted? So, for example, if 85% satisfaction was the market average at the start of the contract, is that relevant today, or do you need to push for 90% to maintain your own competitive edge? And are the year-on-year cost savings sufficient? Or are your own profit margins being squeezed to the extent that you need to drive this further? Mitigating actions are any action you take to try and mitigate the risk of underperformance, because they generally have a cost. Those costs would be things like holding more stock to guard against delivery delays, which results in increased warehouse costs, spreading the supply requirements among several suppliers so that the impact of one underperforming supplier can be offset by transferring the orders to a better claim for costs. These better performing suppliers might result in higher prices because they're receiving lower volumes, or you can renegotiate to permit higher resource allocations. Now, contractual risks are risks to a contract or risks that exist because of a contract. And a risk register is a good place to capture what these risks are, the likelihood and impact of them happening, and then what we're going to do about them, giving them an owner and a time to review this on a regular basis. So the risk register will identify and evaluate the likelihood and impact of the risks. It will identify a risk owner who is best placed to manage the risk, and the initial risk management response, as well as the early warning indicators and what the trigger points might be. Your draft risk register is designed by procurement with input from internal and external stakeholders. The aim is to identify as many types of risks possible so that mitigating actions can be identified ahead of time. The risk register should be reviewed on an ongoing basis in the event of something changing by either party or the wider economic and legal environment. These are the four main areas of risk. Internal organisation risk might come from things like the ability to enforce contract terms because it was never signed, an unanticipated demand for price adjustments, legal action by a supplier for breach of contract, failure to complete procurement programme on time, tender negotiation results in an unacceptable offer, or off-contract spend undermining legitimate contracts. And it could even be financial losses, due to fraud. The market economic risks come from reputational damage, working with suppliers who have unethical practices. A supplier could collapse due to bankruptcy or liquidation. Your cost offers could deteriorate because the contract ceases to be profitable for the supplier. Changes in currency exchange rates, increasing the cost of supply, or any political actions that affect the cost. Performance-based risks are things like late deliveries, non-compliance with the specification, claims for damages as a result of loss of data or misuse, and accidents or incidents in the contract delivery causing injury to staff, visitors, users, or the general public. And finally, force majeure, acts of God, things that are unforeseen, such as the coronavirus right now. It's just important that you understand where these areas of risks are coming from. So you've identified the risk. The next stage is to evaluate the risk. Risk evaluation maps the likelihood of something to go wrong against the impact if it does. This can be evaluated using a simple low, medium, high approach, which we can see on the screen. Others use a sort of 1, 2, 3, 4, 5, where rare would be 1, almost certain would be 5, insignificant 1, catastrophic 5. The highest possible score would be 25, which is 5 times 5, almost certain, catastrophic. That's where you're getting your very high classification from. Most risks need to be analysed in more detail, but essentially what this helps you to do is to prioritise the ones where you've got the highest risk, and then you can decide what you're going to do about them. So that comes on to the next step, which is the mitigation of the risks. Now, the 4 approaches you can take is commonly known as the 4 T's. You either tolerate a risk, which means you accept it, transfer a risk by spreading the risk, terminate by avoiding the risk, or you treat the risk, mitigating, minimizing, or controlling it. So when you tolerate it, it's likely to be one of your low value risks from the previous slide. I'll just click back to show you what I mean. So down here on the left-hand side, these are the types of risks you're likely to tolerate. Up in the top right-hand corner where you've got the very high risks, it's most likely you're going to try and treat or terminate those risks. If you can terminate it, all the better. This will be perhaps stop using a particular supplier and changing to another one. Or to treat it would be to take some steps to manage it in a way that reduces the likelihood or impact. And then across the middle where you've got these sort of moderate and high ones, again, you might want to treat them by minimizing or controlling or transferring the risk. So it could be something like having backup suppliers or negotiating contracts in your local currency or taking out insurance. That's another way to transfer the risk. So just to recap, that's the 4 T's to mitigate the risk. And that's the end of Learning Outcome 4. Thank you for watching.